Hello, good morning all. We'll just give it a couple of minutes so that we can let people join, and then we'll get kicked off with this morning's webinar. I can still see some people joining there, so we'll just give it another 30 seconds. Okay, I think we'll get started in the interest of time. So, good morning, everyone. Thank you for joining the webinar on implementing Basel 3.1 strategies for meeting the upcoming requirements. I have the pleasure of moderating this discussion today. My name is Ronan. I'm an SME here at Suede. And today we're going to be talking about Basel 3.1, the PRA banking package, looking at some of the key updates, including impacts on credit risk and the output floor, and also market risk. Talking about the revised timeline and the implications and recommendations off the back of that. And also providing advice and recommendations on how to successfully navigate these final guidelines once they're released by the regulator, and ultimately to be able to capitalize on Basel 3.1. So to join and assist in that discussion today, we have two panelists, Stephen Hall and Simon Hills. So Stephen is a partner within KPMG's Risk and Regulatory Advisory team. He has over 25 years experience of assurance, risk and regulatory advisory work within KPMG, delivering advisory projects for retail, commercial and wholesale banks relating to Basel 2, 3 and 4, credit risk model development and validation, stress testing, IFRS 9 implementation, risk transformation and model risk management in the UK, Europe and overseas. He leads KPMG UK's Prudential Regulatory Capital work, co-led KPMG UK's IFRS 9 provisioning proposition, and has been the skilled person or concurring partner on nearly 20 S166 engagements. So Stephen, thank you so much for taking the time.
Thank you, Ron.
We're also joined by Simon Hill. Simon leads the Prudential Capital and Risk team over at UK Finance, which focuses on influencing the implementation reforms, the capital and liquidity requirements in the UK. He leads UK Finance's work on the Senior Managers and Certification Regime, the SMCR, which seeks to improve bank-wide governance and culture, and has extensive knowledge of prudential regulatory architecture. Simon's also interested in operational resilience and different types of bank capital and funding instruments, such as bail-inable and covered bonds and securitization structures. His banking background's in fixed income sales, trading and origination, as well as energy and aerospace project finance. He's liveryman of the Worshipful Company of International Bankers and is a former member of the European Banking Authority's Banking Stakeholder Group. So again, Simon, thank you so much for taking the time.
Good, pleasure to be here. And just by way of a little plug, if any of you on the line want to find out more about the Worshipful Company of International Bankers, which is a livery company for bankers, just drop me a line. Ronan, back to you.
Thanks, Simon. So moving on to the topic of discussion today. So Basel 3.1, Obviously, the Basel 3.1 standards are the remaining parts of the Basel 3 standards that are to be implemented in the UK. So in December last year, the PRA published the first instalment of the near final rules, and that mostly covered areas like market risk, CVA, counterparty credit, op risk. And we're currently waiting for the PRA to publish the second instalment of those final rules, which will be covering mostly credit risk and the output floor. So I think it's worth noting at the top of this discussion that some of what we will be discussing today during today's webinar is potentially subject to change and is obviously pending final approval from the regulator. But Simon, if I can just pass over to you to perhaps give us a bit of a high-level overview of where we are at the moment with Basel 3.1 and the path that has kind of been taken to get to here.
Yeah, so you'll remember back in November of 2022, the PRA released CP 1622, quite a big consultation paper on their plans to implement Basel 3.1 in the UK. We put in our response on behalf of members on the 31st of March last year. And since then, the PRA has been having bilateral meetings with firms, meetings with us at UK Finance. I've obviously been meeting with my opposite number at the Treasury as well, and coming up with their final rule book. And what we're waiting for, as you said, Ronan, earlier on, is the phase 2 of the rule book, which covers credit risk and the output floor, which I think we all see for most banks in the UK as being the most impactful elements of the new regime. In putting that response together, we had really good engagement from banks and building societies, large and small. I think we probably had input from something in the order of 50 different firms, probably 250 different subject matter experts. So I think that was a pretty comprehensive response. You can see it on our website. I think it ran something like 168 pages, and we made something like 140 or 150 different recommendations for the PRA to consider. And during that consultation process, we were also having good interaction with the PRA on different topic areas in the consultation period. And I know there's been some bilateral engagement as well, both during the consultation period and after, with individual firms. So I think that clearly about by now, end of Q2, as it said in the regulatory initiatives grid, we'd hoped to see the finalized phase 2 rules. As Ronan said, phase 1 was released back in December, but that hasn't happened. In that, the plan was, and I know a number of you will have signed up to come to a speech that my opposite number at the PRA was due to give on the 28th of May, which would have given us an idea of how the PRA is thinking about some of the top issues, like the top 10 issues that we rate, say SME supporting factor, the sort of slightly illogical higher risk weighting of secured lending to SMEs versus unsecured. So we had a top 10 list, and we were hopeful that at that meeting, my oppo would have given us some views on how they were thinking on those as a preliminary to then releasing the phase 2 rulebook by the end of this quarter. Now, clearly, the calling of the election gets in the way. We're now in what's called the pre-election period of sensitivity, and authorities tended not to put out major policy pronouncements or consult on issues during that pre-election period. So it was quite clear to me once the election had been called that we wouldn't be hearing the PRA's response to our top 10 issues, and more than likely we wouldn't get the phase 2 rule book, because that's like 4 days before the election, isn't it? Now, then we have to look forward to what happens immediately after the election. The rate determining step here is that it needs to be a statutory instrument laid before Parliament to transfer, if you like, the rulemaking power to the PRA from HM Treasury. And this is all part of the better regulation framework, which we all support. And I think, you know, the current government and absolutely more than likely an incoming government would support as well. So I can't think that there's going to be much difference between how an incoming government would look at implementing Basel 3.1 versus how the current government looks at it. But, you know, if I was sitting in the PRA's shoes, I wouldn't want to take the political risk of a new government saying, oh, we want to think a little bit more about this Basel 3.1 thing, particularly the SME supporting factor, for instance. So without the commitment, if you like, by the finance ministry to lay the necessary statutory instrument before Parliament, I think it'd be very difficult to either say anything about those top 10 issues, or indeed, more difficult still, release the finalised rule book. Now, we'll be encouraging the incoming government, whoever that is, to crack on with laying the statutory instrument before Parliament, so that the PRA can then release its finalised rule book. Whether that happens this side of the Parliament, the parliamentary recess, I think Parliament goes on holiday on the 26th of July, or whether it's more likely to happen in September. I suspect we're really thinking about September. And then the issue is, you know, should we be, all of us collectively, PRA, industry, consultants, thinking about what the implication of release of the rule book in September really means. I mean, I've got in my own mind there that, you know, members do really need the finalised rule book to be able to do their capital planning, to be able to do their budgeting. Budgeting, capital planning tends to happen for the year ahead around about September. Firms, as Stephen knows, will be getting ready for the year end, having to do a separate analysis of the impact of Basel 3.1 at that time might be a little bit unhelpful. So do we go on and engage with the regulator about perhaps a further delay? Answers on a postcard to me, please, or if you want to put them in the chat at the same time, do so. And, you know, we need some pretty coherent arguments, like it's about strategic planning, it's about capital planning, it's about needing at least a year, it's needing finality of the rule book so we can do the coding. We don't want to dig up the road twice. Those sorts of issues, if we're going to engage with the PRA on a possible delay. So I think that's pretty much where we are now, unless, Ronan, anything's come up in the chat while I've been burbling on about people's thoughts on whether a delay would be helpful or not. I'm not talking up a delay, but there are clearly issues that we all need to think about together.
Yeah, it's a good point for me to jump in. There is a Q&A section here, so if anyone does have any questions, please feel free to post those through, and then we'll leave some time at the end for Stephen and Simon to address those. Sorry, Stephen, do you have anything to contribute?
No, just picking up on what Simon was saying there about the timelines, and as you said, Simon, the requirement for a sufficiently long period of time to do the implementation once you've got the final rules. Now, I suspect if the PRA was here, they might say, well, you've had Basel 4 rules for a long time. You've had the UK consultation since November. The UK consultation aligns in many cases with the Basel consultation. Therefore, you've had a long time to do this. And whilst that's potentially the case, I think, and many firms haven't been sitting and waiting for the final rules to get on with things, but there is still, as you were alluding to, I think there's a lot of devil in the detail, and there's still quite a few meaty areas that may well change or may have further clarification on it. And therefore, whilst firms to date, and those we're helping and others that we know about, are doing a lot of no regrets work, the point at which your no regrets work sort of stops becomes a bit of a challenge. So I would agree with you, Simon, that there's a compliance lens to this, which is, can we produce the right numbers accurately for the returns that we need to in line with the PRA's expectations. And secondly, there is the strategic business planning side of life that you were referring to, and both of those, I think, come to the fore depending on when the final rules come out.
Yeah, I think there's a further overlay on that as I go through in my mind what we might want to say on your behalf, all of you, to the PRA. You know, there's been a lot of focus on the accuracy of regulatory reporting, and we don't want to rush this because that just risks taking us back a year or so in terms of all the good work that we're doing there in terms of improving the quality of reg reporting.
I think that is quite interesting because, as you say, the last 4 years there's been a lot on that thematic reviews of the accuracy. Some of the references on my section 166 were to doing those reviews, and where things tend to have gone wrong is where implementations in the past have been rushed, not fully documented and not tested. So yeah. I think you make a very relevant point there.
Yeah, so I think there's definitely a lot of moving parts and a lot of moving pieces to this. Obviously, the timeline is one thing, you know, across the different jurisdictions, but there's also, you know, divergence in the actual approaches as well. So I thought it might be worthwhile to discuss some of those and to go into a little bit more detail into those. So Simon, you touched on this in the overview you just gave there, but one of the things the PRA is looking to remove is the SME supporting factor, and that's under both the standardized approach and internal ratings-based approach. And a new exposure subclass is looking to be introduced for corporate SMEs, and a risk weighting of 85%, provided that those SMEs meet the eligibility criteria. So with the phasing out of the SME support factor in the UK, which, you know, effectively applies a variable discount rate, and the introduction of more precise risk weight adjustments, how should UK banks and building societies adjust their strategies to manage SME lending while maintaining financial stability?
Yeah, and I think this goes back to the sort of business planning aspect Stephen and I were talking about earlier on. But rest assured, value members of UK Finance, we're not giving up on you yet on the SME supporting factor. We're continuing to make that point vociferously on your behalf. And we did some work with another consultancy earlier on in the year, looking at the impact of the removal of the SME supporting factor, and indeed the in our view, unreasonably high risk weights for buy-to-let loans. And we used a sort of hypothetical bank model there with, let's assume the bank is all SME lending or all buy-to-let lending. What does that do on its capital requirements? What impact, making some assumptions about cost of capital, what impact might that have on the cost of borrowing? And, you know, there's some pretty big numbers here. So, you know, I've got no inside knowledge on this, but I'm hopeful that PRA, probably after some political interest from the finance ministry, will be able to find a way through that. So it may well be that, you know, we have a transition period. The PRA has said it wants to be closely aligned to Basel, and that degree of close alignment will be judged by the Basel Committee when it next does its RCAP, regulatory compliance assessment process on the UK. Now, that's not, I sincerely doubt if that's going to happen immediately after Basel is implemented, question mark, on the 1st of July 2025. I don't think that procedure will be kicked off before the Basel endgame implementation date, plus a few years in the US. So were there to be a short multi-year transition period for the SME supporting factor, I think that would enable the PRA, when the Basel Committee RCAP team comes knocking, to say, look, we phased it out, but as of the end of the phasing out date, we'll be compliant. And that gives firms the ability to adjust their portfolios to reflect the ending of the SME supporting factor. I mean, perhaps that's an opportunity for me to talk about, as I touched on earlier on, the perhaps somewhat illogical higher risk weighting of secured lending to SMEs, where the security is not income producing real estate. So where it's you've taken a mortgage over the warehouse operators' assets, and that is super equivalently to Basel, I think, proposed to be risk weighted at 100% compared to either a 75 or an 85% risk weighting for SME exposures, depending on how you as a firm manage those exposures. I think we all recognise that's a little bit illogical, so I'm hopeful that will be that will be corrected. Although again, I don't have any particular inside knowledge on that. Does that
Yeah, I think that last one's one of those ones where there's interpretational differences under the current regime as well as to whether that should apply. But I agree with what the perceived illogicality with respect to something that's being secured getting a worse risk weight than something that isn't. I think to some extent some of this goes back to the long legacy of concern regarding the volatility of commercial real estate pricing in the UK from UK regulators over many decades, and the rights and wrongs of that perception that they have with respect to that. I think you can see that still coming through in the design of the rules, can't you?
I think that's right, Stephen. And if I go back to my time at Barclays had to do the largest ever at the time rights issue back in the 90s, because it had engaged with a lot of it had done quite a lot of commercial real estate lending, and haven't been able to get an arm around actually the extent of that commercial real estate lending, because some of it had been done centrally, some of it had been done in the regions, some of it had been done more locally. So there wasn't an aggregated view of how what those exposures were. I'm sure many other banks had the same issues as well, and that's echoed today, where I was talking with colleagues and members yesterday about the Basel Committee guidelines that are in consultation at the moment on counterparty credit risk, and that asks us to look for concentrations, and where you've got concentrations of commercial real estate lending being done all over the business, we need to be able to have a holistic view of that. That's a bit of a diversion, but I think there's a significant interest amongst supervisors around the world in counterparty credit risk, particularly driven at the moment by interest in non-bank financial institutions. So I think supervisors probably thought with rising interest rates, problems would manifest themselves first off in the non-bank financial institution space, whereas, as we know from a year or so ago, it didn't. It was in US regional banks, which hadn't really been paying proper attention to interest rate risk.
Going back to the SME factor, I just wonder, its introduction was a political manifestation of influence in the European version of Basel, and as you say, the UK trying to cleave closely to the Basel text, removing it or proposed to remove it. To your point about the political pressure that might then be applied to mitigate or ameliorate the removal of that. I mean, personally, I think it would be a big call if they completely rode back on their plan to remove. So I think I'm with you that some form of phased transitional adjustment is perhaps more likely in that space at this point. Which again doesn't help the forward planning that we were talking about earlier.
Yeah, and I think, just to remind colleagues on the line about how we got that SME supporting factor. I was in the room at the European Banking Federation when one of our Southern European colleagues proposed this idea. I've done SME lending over my career, and I tend to think it's more risky. So I sat there quietly smiling, and this was proposed at the time when the EBA was getting much more focused on non-performing loans, and some of those banks in this particular Southern European country had perhaps more non-performing loans than average. They were going to see a hit to their capital, and in a way this SME supporting factor was introduced to offset that. And the Basel Committee did, as we've said, in its finalised framework, introduce either 75 or 85% risk weightings for SME lending. I think in the expectation that Europe said, oh, thanks, that's very nice, we'll drop our SME supporting factor. But in fact, Europe, again, political, is having two bites of that cherry.
I can see there's quite a lot of questions actually still on the timeline, Ronan. If we just want to, given we were talking about the challenge with implementing in time, it might be worth covering a couple of those, because people are focusing on, is it the timeline that we expect? Is it the timeline for the finalisation to be done, or is it the implementation being slipped back? And I think it's definitely the rules coming out potentially later, and therefore the knock-on implication of will they push back the implementation timeline on that, which, as I say, is perhaps more uncertain. But to the point that's referenced here, if they don't publish the near final rules till September, that only gives you 9 months to July, and they've always historically said they want to give people a year. So the question is to what extent they provide wriggle room and say that they've given they've previously had the rules out there for some period of time, and therefore it's only the tidying up. But as one of the questions addresses here, there's quite a lot of tidying up, quite a lot of loose ends to look at in this case. So that's the genesis behind the poll that I think the Suede was put up here.
Yeah, it seems to be so. In terms of the PRA implementation at the beginning of July, that's pretty much 50-50. I know 48-52 would be a material difference whether it's a general election, but I read that as, well, we don't really have a first clue whether it's going to be 1st of July or not. And in terms of the US endgame, a slightly large number of people thinking that it's 1 July 2025 is going to be a bit difficult. And of course, they've got an election coming up there as well. But I think you made the point there, Stephen. There are really two questions in this. How quickly can the PRA get the finalised rules out there? And that depends on their confidence that the incoming government will lay the necessary statutory instrument. A decision on delay could either be taken then, or more likely, in my view, a bit further down the road when they've had a closer look at how people are getting on with this. And I think the point we both made earlier on about not digging up the road twice, okay, yeah, fair call to say that the PRA would say, well, you've had these rules since December 2017, what's been stopping you? But it's not until you have the final reporting templates, for instance, what changes you have to make to your coding, and you don't want to do that change to coding twice. You'd rather wait till the finalized templates are out there.
Indeed.
And if there is a further delay, what kind of impact do you think that would have on banks and building societies?
Well, I think it would be welcome in that it would give them more time to plan for what is, after all, one of the biggest changes to the Prudential Regulation regime in at least a decade.
Yeah.
And we know with these sort of large-scale transformation projects, it's not necessarily going to be easy, which is where Stephen Cutler and his colleagues come in to support members as they dig down into what the finalised rule books say and come up with some implementation challenges.
Great. And I think you've got a couple of questions in the Q&A. One about the time, whether they allow any sort of phasing in of the rules once it's come in. Now, clearly, we've got the output floor being phased in. I think the actual phasing in of the adequacy elements of the rules, historically, they tried that in CRR when we introduced that. but again, for most of the larger organisations, it had everyone would go to a fully loaded position anyway, so it made much less difference for the smaller non-market facing organisations. Then I suppose it did provide the flexibility or the wriggle room for the regulators to address capital adequacy. But I think this probably comes back more to the challenges in implementing in a compliant way, as opposed to the capital adequacy that arises from that implementation.
Yeah, no, I think that's right, Stephen. Of course, there is a phase-in period. There is a transition period in relation to the output floor. The smallest firms can opt to decide to stay on or to move to the small domestic deposit takers regime. It's those mid-tier banks that are on the standardized approach, perhaps are on the pathway to IRB. They're going to have they're going to be at a competitive disadvantage from day one in relation to their competitors lending to SMEs or lending to buy-to-let borrowers who are already on the IRB. So we've proposed that there should be, as you say, some sort of phasing in, some sort of transition period for standardized banks as well.
Yeah. And the other bit you just touched on there in terms of the SDDT regime, that you've still got firms waiting for that to come out. It's quite difficult to tell. Yeah. I suppose the best guess is it's broad. I think there's not much hope that, as far as I've recently heard, that it's going to be too beneficial in that regard. So I think we're back very much in the strong end of strong and simple from that. So, but it does make it challenging, as one of the questioners has asked, in terms of making that trade-off or comparison, I think, at this stage.
As I understand it, it'd be interesting to hear if others have heard otherwise. I think we are going to get that third phase of the small domestic deposit takers regime consultation on capital at about the same time as the finalised rule book goes out. So you will have the full suite of options to decide where you want to go. But I think that regulators, and of course the PRA was a key influencer in the design of the Basel framework. I think there's a sense that Pillar 1 is now right for credit risk. So I think that the small domestic deposit takers regime will probably look very much like, will be identical to the credit risk requirements under Basel 3.1 standardized.
Good.
Well, thank you both for all of those insights there. We just touched on the output floor, so I figured that might be a good segue to talk a little bit more about that specific aspect of the proposal. So, for banks that are using internal models, obviously they'll have to now report both the standardized approach and the IRB. So in effect, they'll have double the reporting requirements there. So, I think that could pose quite a big challenge for the banks to be able to calculate using the standardized approach, because that's going to, require additional data requirements that perhaps those banks haven't had to source previously. It might be different to what their internal models currently use, and the banks might not have that available in their reg reporting system. So what kind of challenges do you see, Stephen, for banks, in transitioning to the output floor over that 5-year period?
Thanks, Ren. I think there are two angles, or there's probably more than two, but two that I'll touch on here. One is the compliance angle that you've referred to there, which is, for many firms who are being on IRB, they haven't done necessarily standardized calculations for those sorts of portfolios, and for them that is implementing a parallel calculation engine, which has all the problems that those firms who are doing standardized for all are facing. And as you say, that requires two versions of the truth to be produced. I think what we're also seeing being looked at quite heavily is if you like, the commercial or the strategic implications of the output floor. So, and by that I mean almost a sort of balance sheet optimization strategy, and in particular the case where you've got we've got organisations operating in multiple jurisdictions, and I see a couple of questions about that from a compliance angle, but you see it from a strategic angle as well. So if you've got legal entities in different jurisdictions operating to different rules, and then overlaid that, you've got the output floor looking at differences on the portfolio shape between standardised and IRB, it's driving a desire to be probably a new version of the efficient frontier. You don't want your portfolio to be too far different on the output floor version than it is on the IRB version, or you're probably not managing as optimally from a risk return perspective. Now, in order to do that, it introduces a different, almost financial resource management view that has to be taken by the organisations. Again, better, more active portfolio and capital management, better data lineage, better ability to rerun the calculations on a sort of what-if basis. But I think we're seeing both those angles being looked at by firms. The first is what you were alluding to from a compliance perspective. We've now got to put in place the standardised calculations for all portfolios. And if you, again, take a large portion of the people here probably have large mortgage books. Those who are IRB have been very used to doing IRB mortgage modelling for that mortgage. They're now having to go through some of the same pain, if you will, as on trying to implement the standardised rules for secured on residential real estate, which often is quite the tricky area in the standardised calculations. So that angle is one side, but I wouldn't want to forget the strategic portfolio management view in life, where Basel 3.1 and the output floor have doubled down to some extent on what the leverage ratio historically has done, but are exacerbating that tension.
Yeah, and what I have to say about that, so Ronan, you were thinking about impact on different types of banks of the output floor, and I sense that a large, well-diversified bank, is the output floor going to be binding? You've probably got the flexibility to move exposures around, perhaps deploy capital from the banking book to the trading book, so the output floor doesn't really bite. But if you're, an IRB firm with, pretty plain vanilla mortgage lending, we all know who those sorts of firms are, this is going to make a bit of a difference on you.
And how do you think banks can optimize their internal models then to align with the output floor requirements if they are using?
I think this is where the point about we need to see the final rules, because then we can get on with the business of deciding on a business mix to optimize capital returns. And until the final rules are there, we're all sort of waffling around a bit, aren't we?
Yeah, I think it's more about portfolio mix and legal entity structuring and organisation and other portfolio mitigants, rather than specifically, to use your words, Ronan, optimising the IRB models. So I don't think we're in the business of adjusting or tweaking the models to try and consider where they are against output floor, but it's understanding, given your IRB risk weights, given the standardised risk weights, what does your portfolio mix look like? Do you change where you position yourself, orient yourself? So again, historically, you saw a lot of standardised firms target some of what you might think of as the higher risk, higher return product, and the IRB firms targeted the lower risk, lower return products, because they could assess the risk more appropriately and therefore get better risk weights on them. Some of those dynamics change when you move to an output floor model. So understanding that portfolio mix and where you position yourself is important, rather than tweaking the IRB parameters themselves.
Yeah, because I think we should all remember, shouldn't we, that we do this to do risk management better, not to goal seek to a particular return on equity.
Mm-hmm.
Yeah, it's a great point around the portfolio mix there. So thanks Stephen and Simon for that. If we can jump back to, there's been some quite considerable changes in real estate. Obviously, particularly around the change in valuation and indexing approaches. So this is another change that diverges from the EU, but the proposal is to do away with market valuation for real estate and instead use the value at origination. So, the time of issue of a new mortgage or refinancing of a mortgage secured on property. The idea being that then mitigates any potential impact on risk weights due to cyclicality in house prices or the housing market. So what kind of impacts do you think that this the lack of LTV indexing will have on mortgage lending for banks and building societies?
I think if can I leap in?
Go for it, Simon.
Going back to the sort of history of this, we were in the room on your behalf in Basel when they were talking about origination value for loan to value calculation purposes, and we were very vociferous that this is not going to work. And why isn't this going to work? Well, it's going to have to work, but it's going to be very difficult for us to, in some cases, I'm sure, to find the origination value of a mortgage going back a good number of years. And the PRA has, helpfully come up with a bit of a way around this. So where there's a major event in relation to the mortgage, you can use that as a point of revaluation. And given that most mortgages historically in the UK have sort of refixed in some sort of way every couple of years, that seems helpful. But we now know that, I don't know how long my kids are borrowing on their mortgages, perhaps I should, but, younger people these days are borrowing for a long, long time, 35 years in some cases. And, if they stick with that, they can't increase their borrowing so easily as the market value of the home goes up. In relation to AVMs, I think we can be quite hopeful that the PRA doesn't want to do away with the use of automated valuation models for when there is a mortgage event. I'm reasonably confident about that. Stephen, I don't know if you've got any thoughts on AVMs or...
No, I would agree with you on that one. I think that there's more support for that, which is helpful. I think in the context of the origination one, I don't know, from an unintended consequence, the encouragement of churn or swap between providers, and therefore, again, you've got financial stability rules butting up against some of the sort of consumer duty, consumer protection rules here, which is probably an unintended consequence if people do go down that route. But I agree. And again, I know we've got some attendees here who are either from European firms or subs of European entities, and the European version of this is different again from the Basel and the UK text. Again, you've got that sort of different approaches being adopted here. So again, geographical dispersion, which is never helpful for those organisations having to implement things in multiple ways depending on where the parent of the group sits.
Thanks for that. Yeah, I think it'll be interesting to see what happens with that unintended consequence, as you say, Stephen, around, is there going to be potential churn created with, 2-year fixed rate mortgages, for example, being priced cheaper than 3-year fixed rate mortgages to encourage that refinancing and therefore the new valuation to be undertaken. So interesting to see what happens off the back of that one as well. Moving on to the lending to unrated corporates. So for exposures to unrated corporates, the PRA has proposed adding a new risk-sensitive approach. So that will allow firms to distinguish for unrated SMEs, an 85% risk weight will apply, and there's a new grading system and risk-sensitive approach for the unrated corporates. So how is that going to influence banks' internal rating systems and capital allocation strategies, Simon?
I think this is a pretty important one, because we remember the reason behind this what is 100% in the Basel framework, 100% risk weighting to unrated corporates. I mean, that links back to the sort of US's ongoing skepticism about EU banks, European banks, other banks that are not US banks, being given a free pass by their regulators, effectively, not terribly severe, challenge, as they sought to move on to the internal ratings-based approach. So as you said, there's the option which the PRA has come up with. You either use 100% or you use a 65% and 135% if you can reassure yourself that an obligor is of equivalent to investment grade, then you can use a 65% risk weight. But the flip side of that is that if you can't, then you've got to use 135% risk weight. Now, I did hear the PRA say they thought on average this would bring overall risk weights for unrated corporate lending down to a little below 100%, but it depends entirely on firms' books, doesn't it? So we welcome that hybrid option that the PRA has proposed. But we do think that there should be a third risk weight introduced for financial firms that are not banks or building societies, but are nonetheless regulated, to have a 100% risk weight. So if I'm lending to a open-ended investment company or an investment manager of some description, I can't determine what their credit rating, whether they're investment grade or not, then I've got to risk weight them at 135%, because London is a centre of that sort of business. So we did propose that there should be a 100% risk weighting under the standardised approach for those sorts of business.
I think the other challenge, Simon, is whether people will bother with the 65-135 or whether they'll just stick with 100, given the way that it's articulated around it's another approval to do something within a standardised, or mini approval within a standardised approach. And the fact that if you're an IRB firm, the IRB isn't sufficient to, or the IRB approach isn't sufficient to justify that. So you've got a slightly unusual situation where a firm with an approved model is then going to get a slightly less sophisticated approach that has to be approved by the PRA to act as the backstop under the
output floor.
Yeah, for their approved model that has gone through a lot of energy and effort. So
just testing my understanding of that, Stephen. So obviously, if you're an IRB bank, you've gone through the model approval process, tortuous as that may be. You've got to do your standardized calculation as well. And you're saying that to use which I think I understand to be the case, that to use the 135 versus, or 65 versus 135% for your standardized approach calculation under the output floor, you've got to apply for approval from the PRA to do that.
Yes,
that's correct. Yeah,
and the nuance I was suggesting was that the IRB mechanism can't be the only thing that's used to determine if something is investment grade or not. So you end up in, let's say, this slightly perverse situation that you've gone all through this effort to do IRB to get the approval, and then as a backstop to your IRB, you're going to have to do some adjustments to that, to go through a semi-different process to work out. Use 135 as your backstop to that. So.
Might the sort of counter arguments that be, though, that if you're an IRB bank and we know you've got to do appropriate due diligence on your ability to discriminate between investment grade and non-investment grade, you might think that an IRB bank would be able to do that better, so might be more inclined to take the 65, 135% approach, whereas a standardized bank perhaps hasn't the same degree of credit sophistication.
No, I completely agree with that in terms of the rationale. Again, to the extent to which it's who is it helping as part of that activity on again, the unintended consequence that you just described, the unintended bias to that.
Well, speaking of that, that due diligence that the banks are required to do there in order to get approval from the PRA, to use the risk-sensitive approach. In the same conversation, banks are now being asked to undertake their own separate due diligence on external rating providers. So the PRA is proposing to introduce stricter rules on how that functions. And in the event that firms' due diligence that they undertake finds a higher risk weighting than the external rating, then that must be reflected in the exposure risk weighting. So I guess firms will need to implement quite robust internal processes there to be able to map out and identify the risk characteristics of their exposures. So what kind of challenges might banks face and building societies face in implementing that requirement, and specifically the smaller banks or building societies? Simon, please.
I think they're probably going to have a bit of a challenge there, frankly. The smaller firms, as I say, I think the larger firms will be well set up to do this. But but also we've spent a lot of time thinking about the role of ECIs, external credit assessment institutions. And they are far more regulated than they were in the run-up to the global financial crisis. So I'm not so sure on the answer to that question, but I think smaller firms are going to find it more difficult than larger ones.
Yeah, because I think, again, to the extent to which firms already go through a credit risk management assessment process before they, as part of their credit policies for lending to those sorts of organisations, then as you say, Simon, I think arguably that ought to be, one would hope that is sufficient as part of that exercise. And typically in those cases, the ECI rating is one element of that internal credit assessment process in terms of determining credit limits and facilities to rated institutions. I think to your point, the smaller, less sophisticated and less complex the organisation, the more they might tend to rely on the external ratings as being a better assessment than what they can do internally. It's a question of how much top up they need to do in just terms of news and other intelligence in the marketplace to assess that, whether that's still appropriate.
Yeah.
Thank you both for that. All right, we've got about 8 minutes left. There's still quite a few questions that have come through that I want to leave some time for, but I've just got one more question for both of you, just around data and systems and data lineage. So Stephen, I might start with you. What are some of the key challenges that you think banks face in ensuring that they have data lineage and data quality for their regulatory reporting under Basel 3.1?
To some extent, Simon alluded to some of this earlier in respect of there has been a lot of work to try and improve this area, not just for Basel 3.1. So to get the current regime reported, calculated appropriately and accurately. And if you look at a couple of the themes that come out of the reviews that will have been done over the 3 or 4 years, data, the answer's data, then what is the question tends to be the sort of phrase here. So data systematically is giving rise to some of the calculation errors. And you can see where the regulators have come from, that quite a lot of these data fields that are used for regulatory reporting aren't subject to the same historic scrutiny and control processes as some of the data that's driving the financial reporting calculations. So I think regulatory reporting relies on quite a lot of other parameters that are driven off front office systems, as opposed to that don't necessarily always drive into the financial reporting systems. So understanding that lineage back to source has been a key part of the current process, not least then when we overlay Basel 3.1, we have some additional data fields that we need to put into that mechanism, particularly as we touched earlier on the real estate and the fact that everyone is now doing, all the larger firms subject to output floor will also be doing the standardized calculations. And it's in those standardized calculations that you might historically not have been capturing the relevant data to do those, because you were relying on data feeds going straight into credit risk, PD, LGD, EAD models. So it's a sort of taking that plumbing and taking it across into the standardized world is also proving a challenge. Even for some firms who've got, let's take on the more wholesale institutional side. I know one organisation they had IRB models for that portfolio. They don't capture some of the external ratings that they need to drive a standardized calculation, because they've always done it through the IRB route. So even on that one, that's pure data inputs as opposed to data lineage in this case.
And I think we shouldn't forget that at the same time, you've all been thinking about your model risk management. It's now an identifiable risk in its own right. And was it the 17th, Stephen? People were supposed to have done their assessment. I don't think there's any. You'll be closer to this than I will, Stephen, but I don't think there's any requirement. You've actually got to submit that unless you've been asked to the PRA, but you've got to stand ready to share your assessment, your mapping of the expectations in that policy statement from about a year ago to what you actually do, and have a remediation plan in place.
Yeah, there was no expectation that you had to submit, but just many of the firms I don't know who's on the call, but many firms have been asked for that self-assessment by the PRA.
Okay.
They're not by no means anyone. It tends to be in the larger organisations have been asked. I suspect we're going slightly off piece there, but the PRA will be examining those self-assessments and deciding how good they've been, how well they have been produced, and also how much remediation effort firms have, and therefore the extent to which they want any follow-up on that.
And then you might be adding to your tally of Section 166's report, Stephen.
Potentially, yes. I've done some on model risk management, but we expect potentially more thematic ones similar to the reg reporting ones, rather than the idiosyncratic ones that we've seen in this case.
Interesting. Yeah.
Thank you, guys. We've got a question here that was sent in before the webinar. So we touched on this briefly, but given that the move from 76.19% to a flat 85% for the SME factor, does this simply mean the regulator has nowhere to go except to remove or reduce the counter-cyclical capital conservation buffers to compensate? Does anyone have any views on that?
I think, as we said, sorry, Stephen, I cut across you.
After you.
I think, as you said, we're hopeful we'll have some sort of transition period which will allow firms to amend their business models. There's the Pillar 2 process, and we know that we're on a promise that the PRA will look at your Pillar 2A number to avoid any double counting. So I think there are a number of mechanisms, but it's still quite a significant increase in risk weights, isn't it?
Yeah, and I was going to cover on the Pillar 2 piece that's the, I suppose, the other moving part. I think that the challenge is whether there's sufficient Pillar 2 surplus, if you like, on some firms to cover the potential increases. Yeah. And I know one of the questions raised was, the regulators have historically said that they're broadly comfortable with the level of capital in the system. So, and this is more about redistribution rather than overall increases. The extent to which that flows through in practice when we see the final rules will be interesting to see.
Perhaps the question is actually opening up another debate, which is about the countercyclical capital buffer, which, as we remember, was put in so that lenders didn't withdraw as the economy turned down. So there's a continuing flow of credit to the economy because the countercyclical buffer would be released, which is why we have a non-neutral CCYB point. And I think that's being introduced more widely around by supervisors and regulators around Europe as well. But given that some firms are not seen as systemic, some smaller mid-tier banks and smaller firms, should they actually be required to hold a countercyclical capital buffer, the purpose of which is to encourage them to keep on lending when the economy turns down or not? I don't know if people have got any views on that. Again, let us know. Well, I know what you'll say. Smaller firms shouldn't be subject to countercyclical capital buffer. And the argument is that we're not expected to continue lending when the economy turns down.
Well, we are just about at time, so we might leave it there. Simon and Stephen, thank you so much for taking the time today. That was hugely insightful. I know I learned a lot. I hope everyone else on the webinar also feels the same. But really appreciate both of you joining, and to everybody who's dialed in and attended the webinar, thank you for your participation. Thank you for your questions that you've sent through. If there were any that we didn't get around to answering, then we can come back on those questions after the webinar. But yeah, I think we'll leave it there. Thanks all. Have a good day.
Have a good lunch.
Thank you. Bye-bye.